Warriors of price action and guardians of fundamentals, welcome to Retail Recon. On today's episode, we're covering one of the most powerful and dangerous tools in retail trading, margin. Margin can help you control larger positions with less of your own money, but it can also amplify losses just as fast as it amplifies gains. The objective is simple: understand exactly what margin is, how it works, why traders use it, and why beginners need to treat it with respect. What margin really is? Think of margin as borrowing ammunition from your broker. Instead of using only your own cash to buy stock, the broker lends you part of the position and uses the assets in your account as collateral. That extra borrowed buying power can let you open larger trades than your account balance would normally allow. If you deposit $5,000 into a margin account, you may be able to control up to $10,000 of stock in a standard Reg T setup because the broker is effectively lending you the other half. But the loan is not free. You pay margin interest on borrowed funds, and that interest chips away at your profits if you hold positions for too long. The most important beginner takeaway is this: margin does not create free money. It creates leverage, and leverage always cuts both ways. A margin trade starts with a margin account, not a cash account. To open one, brokers usually require an application, an agreement, and at least $2,000 in minimum equity or 100% of the purchase price, whichever is less. Under standard US rules, the initial margin for most stocks is generally 50%, which means you put up half the trade value yourself and borrow the rest. The maintenance margin is the minimum equity you must keep in the account after the trade is open, and for many stocks that floor is around 25%, though brokers can require more. If your equity falls below that threshold, you can receive a margin call. A margin call means you must add cash or sell positions to bring the account back into compliance, and if you do nothing, the broker can liquidate positions for you. Why traders use margin? Traders use margin for one main reason: capital efficiency. Instead of tying up all your cash in one position, margin lets you size up, diversify, or take a trade with more impact than your cash balance would normally allow. For a trader with experience and discipline, that can be useful. For example, if you have $10,000 and you want exposure to $20,000 worth of stock, margin can make that possible. That does not mean the trade is safer or smarter, it only means the position is larger. In practice, margin can help active traders when they need flexibility, but it should never be confused with a reason to take on extra risk just because the broker allows it. How margin amplifies trades? This is where beginners need to pay close attention. If a stock goes up 10%, a cash buyer earns 10% on that position. But if you used margin and controlled twice as much stock with the same amount of capital, your return on your own money can look much larger because you had more exposure, naturally. The same works in reverse. If the stock falls 10%, the loss also hits you harder on a return on equity basis because you were exposed to a larger position relative to your own capital. This is why margin can make a good trade look great and a bad trade look devastating. Here is the battlefield lesson: margin does not improve your edge. It only magnifies the result of the edge you already have. The biggest danger with margin is that losses can snowball quickly. When a position moves against you, your equity shrinks, and if it shrinks far enough, the broker can issue a margin call or liquidate your holdings. Interest is another silent enemy. Borrowed money costs money, and if you hold a margin position for too long, the interest expense can eat into gains or deepen losses. In a sideways market, that can turn a position that looked fine on paper into a mediocre or negative trade after cost. There is also the psychological risk. Margin can make traders overconfident, oversize positions, and ignore risk management because the account still looks healthy at first. That is one of the fastest ways retail traders get hurt. Initial margin versus maintenance margin. These two terms matter a lot. Initial margin is the amount you need to open the trade, and for most stocks, that is generally 50%. Maintenance margin is the minimum equity you must keep after the trade is live, and that minimum is commonly around 25% for long stock positions in a margin account. Think of initial margin as the ticket to enter the battlefield. Maintenance margin is the line you must keep defending once you are in. If your account falls under that line, the broker can force action, and that usually happens at the worst possible time. The easiest way to think about it is this. The broker is lending you money, but only as long as your account still has enough value to protect that loan. Margin can make sense when it's used with a plan. Some traders use it for short-term opportunities where the risk is defined and the thesis is strong. Others use it for temporary flexibility, such as when they want to enter a position before moving cash around or closing another trade. It can also be useful for experienced traders who already know their position sizing, stop placement, and maximum drawdown. In that case, margin is a tool, not a crutch. But for beginners, the best use of margin is often not using it at all until the basics are deeply understood. When to avoid margin entirely? Avoid margin if you're still learning how to size positions, set stops, or manage losing trades. Avoid it if you are trading volatile names you do not fully understand, because a fast move can trigger a call much faster than you expect. Avoid it if the only reason you want is because you can do more with the account. That is not a strategy. And avoid it if seeing temporary drawdowns make you panic, because margin leaves much less room for emotional mistakes. A good rule for beginners is simple. If you would not be comfortable taking the trade with cash only, you should not be taking it with borrowed money. Let's go through some common mistakes. First mistake. Using margin to take too large a position. The account may look powerful, but in reality you are just increasing the size of a possible mistake. Second, not understanding interest. Borrowed money costs money every day, and that cost matters more than people think. Third, ignoring maintenance margin. Traders often focus on the entry, but the real danger is what happens if the trade moves against them later. Fourth, assuming the broker will give time. In a fast market, margin calls can lead to forced liquidation, and that usually removes your control over the trade. Fifth, using margin while already overtrading. If your process is not disciplined, leverage will not fix it. It will speed up the damage. On screen, you have a field card for margin. Press pause and screenshot it for your future reference. Margin is borrowed money used to increase trading power, and that extra power can help or hurt depending on the quality of your decisions. It can magnify trades, boost returns, and create flexibility, but it also increases losses, adds interest costs, and introduces the risk of margin calls. For a retail trader, the right mindset is respect, not excitement. Margin is not a shortcut to success. It's a force multiplier for whatever habits already exist in your trading. If your process is strong, margin can help. If your process is weak, margin will expose that weakness faster. On our next episode, we will do a deep dive on the difference between options and futures. If this mission helped you understand the margin, lock in your support by liking, subscribing, and following our movement. Thanks for standing watch with me today, and until next time, trade smart, risk sharp, and stay on target.